Hi viewers, welcome to the Trading for Living video series. Myself Brijesh Bhatia, Senior Research Analyst and Editor at Equity Master. So in the last video, we have done how to define your trading systems. With the trading system, it is equally important how to manage your risk. So in this video, I'll be discussing on something on risk parameters. So before moving on to the video, click on the subscribe button and press the bell icon so that you receive the notifications instantly as soon as we upload the videos, and do comment on our videos so that it helps us to come up, motivate us to come up with more and more videos. So coming on to the risk parameters. So basically, what are risk parameters? You might have an excellent trading systems which gives you amazing returns. Excellent, I would say you might be following this excellent trading systems, trading rules day in, day out. You might be disciplinarily following stop losses. So you have seen n number of videos where most of the speakers talk about the stop losses. So stop losses are very much important in your trading journey because it limits your risk. At the same time, how do you define your stop losses? Your trading systems depend on n number of risk parameters. So in this video, I'll be discussing the n number of various cases on how to look at the risk parameters. Before that, there are three key important parameters you should look at into the risk parameters. First is risk to reward. Second is strike rate or win rate or hit rate, whatever you say. Both these are very much correlated. Risk to reward and strike rate. And the third important parameter is risk per trade, what number of amount of risk you are taking on your per trade. So your capital might be different for n number of traders. So for you might start with 100 lakh, I might start with 10 lakhs. So it depends on what are the capital you have deployed when starting with the trading career. So I have just taken some of the cases. So let's look at risk reward first. When you look at the risk rewards, I've just taken three cases over here. When your risk to reward is 1:1, what does 1:1 mean? If you are gaining 1% on your trade and you are taking a risk of 1% on your trade, which means that every winning trade is giving you 1%, every losing trade is taking off 1%. So here my risk reward is 1:1. So let's take it 10 trades as an example. So in 10 case, if you look at the 20%, the strike rate or win rate or hit rate, whatever you say, is 20% of your trade. So out of 10 trades, you had only managed to gain on 2 trades, profit on 2 trades, and that's to 1%. So end of the trades, so I'm just taking that you are investing fixed amount on per trade. So at the end of the 10 trades, if you are deploying 10% of capital on every trade, so if you look at 2 profit sheets giving you 20%, but if you look at the loss trade is taking off 80%. So in the net you are down with 60%. Same is the case with 40% strike rate on 1:1, which means that you are risking making one profit of 10% per trade, losing 10% per trade. So out of 10 trades, if your strike rate is around 40%, so 4 trades have gone right, 6 trades have gone wrong, and you are losing 20%. In this case, 1:1, your break even will be only when your 5 trades go right, 5 trades go wrong, which means that 50% strike rate. You might be at no profit, no loss. So now think that you have, if you have done so much thought process when it comes to trading system, but as per the risk parameter, it is not working. So now let's look at 70% strike rate. So your 7 trades are going into the profit, 3 trades going into the loss, and you are making 40%. So still at higher strike rate, you have managed to get 40%. Now look at the scenario where your trading system should be 1:5, 1:1:5, which means that every trade you are making profit gives you 15%. At the same time, it takes a loss of 10%. So 1.5% profit against the loss trade of 1%. Now this is very much important. Now let's look at when you were doing 1:1, your 50% strike rate was no profit, no loss. In this case, your 40% strike rate is giving you no profit, no loss. Why? So let's look at the 20% strike rate scenario first. Your 2 trades are going right. You are making 30% on your profit, because 1 is to 1.5 is to into 20% is nearly 30%. At the same time, 8 trades are going loss, so you are making 80% loss over there. So your net is 50% down. In 40% case, your 4 trades are gone right, you made around 60%. You are gone long on 6 trades, so you made a loss of 60%. So at the end, you are no profit, no loss. So when such scenario comes at 50% strike rate as well, you are managing to make a profit of 25%. And average, generally the traders are above 1.5, because the thumb rule of making money is not into the trading system but into the position sizing and risk parameters. So risk parameters plays a key role. Now look at the third scenario over here, 1:2, which means that every profit trades you are making 20% or 2%. Every loss trade you are making 10% loss or 1% loss, depending upon the capital you are deploying. So again, I am using the same capital, 10% per trade. Now if you look at the scenario at 20% strike rate, you made a profit of 2 trades, you made a profit of 40, and on the 8 trading loss trades, you made a loss of 80%. So here still you are managing to gain loss 40%. In the first scenario where 1:1, you managed to lose 60%. Now at the 40% strike rate, even at 40% strike rate, so most of the system will give you on an average 40% strike rate. The key thumb rule is the risk parameters. The more number of profits, the more number of reward per risk plays a key important role. So if you look at the average algos trade, or on the number of websites, they have an average strike rate of 45, 50, 55%. But here the key is the risk parameter. They are gaining risk to reward is 1:2, 1:2.5, 1:8. So I'm taking a round figure of 2%. So at 40% strike rate, your 4 trades is giving you 80%. 40%, 4 trades into 20%, it's 80%. And your 6 losing trades is taking out 60%. So still you are managing to gain 20%. At 50% strike rate, look at 50% returns you are making. So the risk to rewards plays a key important role when it comes to the trading. Now look at the another table over here, capital deployed. Okay, that was the strike rate which I have discussed, and risk to reward. Now the risk per trade is also important. So let's take in, you have started with a capital of 100 lakh, so which is around 1 crores. Okay, and per trade I am investing 10%. So 10 lakhs I have deployed per trade. Okay, repeating again, you have started with 100 lakhs, you deployed 10%, so which is 10 lakhs, and per trade you are taking 10% risk. So 10 lakhs, 10% of 10 lakhs is around 1 lakh. So I am taking 1 lakh risk on capital of 100 lakhs, which is 1%. So to wipe off my capital, I have to go 100 times wrong, which is nearly impossible. No traders can go 100 times wrong, right? So even though if you are deploying 10% of your capital on per trade, but managing to take a risk of 10% on that trade, you are losing 1% of capital. Look at second scenario over here, case 2. You have deployed 100 lakhs, 1 crores, started 20% per trade, which is again 20 lakhs. I am taking 10% risk, so which is 2 lakh rupees per trade, which is still 2% capital, 2% risk on your capital. So on an average, you shouldn't risk more than 2 to 3% on your capital per trade, on your capital, not on per trade. So per trade risk should be 2 to 3% of your capital. Now look at case 3 over here, and case 4 will be very much important for you. Look at case 3. I am deploying 20% per trade, which is 20 lakhs of 100 lakhs. I am taking a risk of 25% over here. Risk of 25%, which is around 5 lakhs. Okay, and which is 5% of my capital. So if I go 20 times wrong, which can be scenario, say you are holding 5-6 trades, and at some point of time, what happened? What do you know what will happen? Like Brexit, markets gap down on a huge, and you don't get exits even at 25% of your capital. So you might lose out all your capitals. Now look at the case 4 over here. Okay, again I'm investing 10%, but I'm taking a risk of 50% per trade. That is also, which is again 5% per capital, and I am managing to take risk of on 20 trades. So case 4, case 3 and case 4, even your risk parameters increase or decrease, but the amount of capital deploy also plays a key role. So it shouldn't happen that you are increasing your capital per trade, investment per trade of your capital, but reducing your risk parameters. Again, that will be a key psychology player over here. So try to take 2 to 3% risk on your capital, which is advisable by fund managers, which are advisable by the person who are holding a number of PMS stuffs, the capital, higher capital amount. So I generally prefer 1.5% on my capital, but 2 to 3% is advisable if you have a slightly larger capital. But if you are starting with lower capital like 50,000, so there it is very much important that you don't risk 2 to 3% more. Okay, so that's all. Keep things in mind when you are defining your trading system. Risk parameters plays a key role, strike rate plays a key role, and risk to reward trades play a key role. Because risk to reward, if you go higher and higher on risk to reward, your trading journey is attractive, your trading journey is enjoyable, you are not into a pressure of ups and downs frequently. So a good 3-4 trades a month with higher risk, a lower risk, higher reward will give you amazing profits. So try to focus on risk to reward, because on a strike rate you won't get any systems which is giving you 80%, 90% strike rate consistently. So there can be average of 50-60%, but when you play a good on risk parameters and good on risk to reward, it plays, your systems automatically change, your profit and loss statement will automatically change. So keep these things in mind. Thank you. Do not forget to subscribe to my email newsletters, Fast Profits Daily, and get a free guide on how to trade markets like pro. Thank you.